The intervention worked briefly. The market recovered by the close of October 24th. Newspapers that evening described the crisis as contained. The worst appeared to be over. It was not over. The following Monday, October 28th, became what historians call Black Monday. The Dow fell 12.8% in a single session. No intervention materialized. The selling was too broad and too fast for private coordination to absorb. Tuesday, October 29th, Black Tuesday. 16 million shares traded. The Dow fell another 11.5%. The two-day loss erased approximately $30 billion in market value. That figure was larger than the total amount the United States had spent fighting the First World War. The mechanisms of collapse were the same mechanisms that had driven the expansion, simply operating in reverse. Falling prices triggered margin calls. Margin calls forced liquidations. Forced liquidations pushed prices lower. Lower prices triggered more margin calls. The feedback loop that had inflated the market now deflated it with equivalent speed and far greater violence. The bankers' intervention that had stabilized October 24th was not repeated at scale on the 28th or 29th. The losses were too large. The coordination required was beyond what private actors could assemble in real time. Liquidity, the ability to convert assets to cash, disappeared not because money ceased to exist, but because everyone needed it at the same moment. When everyone sells simultaneously, there are no buyers. Without buyers, there are no prices. Without prices, there is only uncertainty. Confidence, which had been the load-bearing structure of the entire expansion, did not bend. It did not gradually decline. It collapsed in the span of hours, and it could not be reassembled by announcement or by intervention, or by the reasonable observation that the underlying economy was still largely functional. Trust, once broken at scale, does not respond to logic. This is one of the harder lessons economics has spent a century slowly learning. The break had a precise date, but it did not have a precise cause, in the sense of a single decision or a single failure. It was the terminal point of a process that had been building across years. The crash of October 1929 was not the beginning of the Great Depression. That distinction is important and frequently misunderstood. The crash was the breakpoint. What followed was the consequence. The immediate aftermath of the crash was not the Great Depression. October and November of 1929 produced shock and contraction, but the full depth of the economic collapse took years to develop. This delayed arrival of the worst consequences is itself significant. It explains why policy responses in the immediate aftermath were sometimes misdirected. The true scale of what was unfolding was not immediately visible. By the end of 1929, the Dow had lost approximately 40% of its peak value. By the summer of 1932, it had lost nearly 90%. The full descent took almost 3 years. Industrial production fell by nearly 50% between 1929 and 1933. The drop was not uniform. Some sectors contracted faster than others, but the breadth of the decline was historic. Unemployment, which had stood at approximately 3% in 1929, reached 25% by 1933. 1 in 4 American workers who wanted employment could not find it. These are large numbers. What they represent in human experience is difficult to convey through statistics alone. 25% unemployment meant that in most American towns, a significant fraction of the adult population spent years without regular income. The banking system, which had funded the expansion, now became the primary mechanism of contraction. When loans went bad and deposits were withdrawn, banks failed. When banks failed, the deposits of their customers were lost. There was no federal deposit insurance in 1929. Savings were not guaranteed. A bank failure did not just reduce wealth, it eliminated it. Families lost savings accumulated over decades in the course of a single institution closing its doors. Between 1930 and 1933, approximately 9,000 banks failed in the United States. This was not 9,000 large institutions. Many were small community banks, serving specific towns or rural counties. But their failure removed credit from local economies at precisely the moment when credit was most needed. Milton Friedman and Anna Schwartz, in their landmark 1963 study of American monetary history, argued that the Federal Reserve's policy responses between 1929 and 1933 transformed a severe recession into a historic depression. The Fed, concerned about gold reserves and inflation, tightened monetary policy or failed to ease it sufficiently as the banking system collapsed. By the time the scale of the contraction became undeniable, the damage was already structural. This is one of the lesser discussed details of the Depression. The initial crash was a market event. The depression that followed was substantially a monetary and banking event. The two are connected but not identical. Conflating them has led to historical misreadings that persist. Agricultural America had its own particular story. Farm prices had been depressed throughout most of the 1920s, even during the general prosperity. The crash accelerated what was already a slow decline. Farmers who had borrowed to expand during the wartime demand of the 1910s found themselves holding land that could not generate enough revenue to service the debt. Foreclosures moved across the American Midwest in patterns that preceded the broader urban unemployment by years. The Smoot-Hawley Tariff Act, signed in June 1930, raised import duties on over 20,000 foreign goods to historically high levels. Its stated purpose was to protect American industry and agriculture. The consequences were the opposite of the intention. Trading partners retaliated. American exports fell sharply. International trade, which had been one of the genuine strengths of the 1920s economy, contracted. Global economic interdependence, which creates wealth in growth, distributes damage in contraction. This is a recurring lesson in economic history. Protective measures implemented during contraction tend to reduce the total size of the economy being protected, while creating a visible but misleading sense of defensive action. By 1932, gross domestic product had fallen approximately 30% from its 1929 level. In real terms, the American economy had been pushed back to roughly the productive level of the early 1920s. Nearly a decade of genuine growth had been erased. The political consequences arrived with predictable speed. Herbert Hoover, who had been elected in 1928 on a platform partly built on the prosperity of the decade, was decisively defeated in 1932. Roosevelt won 42 of the 48 states. The election was not primarily about ideology. It was about the failure of existing institutions to contain a damage that had already penetrated ordinary American life. Elections during severe economic contractions almost always produce leadership change, regardless of the quality of the incumbent. Roosevelt's first 100 days in office produced a volume of legislation that remained historically unprecedented for speed and scope. The Emergency Banking Act was passed within days of inauguration. The Federal Deposit Insurance Corporation was created in 1933, guaranteeing bank deposits for the first time. The Securities Exchange Act of 1934 established the Securities and Exchange Commission, creating the first comprehensive federal oversight of securities markets. The Glass-Steagall Act of 1933 separated commercial banking from investment banking, reversing the structural integration that had contributed to the expansion of speculative credit. These reforms were not radical departures from capitalism. They were structural adjustments designed to rebuild the institutional trust that the collapse had destroyed. The goal was not to eliminate markets. The goal was to make markets legible and accountable enough that participants could trust them again.
It is simply clarity. And clarity, in economic history as in most other domains, is the beginning of everything that follows. The Great Depression was not a mystery, it was a pattern a pattern built from real growth, gradual distortion, structural leverage, behavioral amplification, and the fundamental fragility of systems whose strength depends on collective belief. The belief held, and then it did not hold. And the distance between those two states turned out to be the largest economic contraction in American history. The reforms that followed attempted to address the mechanisms. They were, for a time, genuinely effective, and then the memory of what they were designed against gradually softened into abstract history. That softening is not a moral failure. It is a human one, and human tendencies, unlike institutions, do not require legislation to reassert themselves. The question is not whether the next cycle is already assembling itself somewhere in the structure of the present. The question worth sitting with, quietly, is whether the distance between what we can measure and what is actually accumulating has ever been as comfortable as we tend to believe it is. The economic record. History does not repeat, but it does rehearse.